Hello, and welcome to Definiti's 30th annual 401k class. We're delighted to have you here. You are joining nearly 600 other participants in this, our 30th edition, together with 35 speakers and panelists. So it's quite a week we have ahead of us. A little history on the 401k class. It began as a regional, local educational series for plan sponsors in the Pacific Northwest. And over the years that grew until it's become what it is this year, a week-long online webinar series with 2 tracks, with 22 session topics, and all sorts of industry experts from both Definiti and some of the most trusted and respected names in the industry. All of the sessions that we're conducting this week are for you. They're free of charge, and we encourage you to take advantage of as many of them as you can. If you could switch to the next slide, I'd like to have a special thanks to our sponsors. Oh, okay, well that's me. I'll introduce myself in a second. Our sponsors you can see here: John Hancock, American Funds, Empower, Transamerica, T. Rowe Price, The Standard, Emeritus, Ascensus, Leaf House, and Financial Finesse. All have helped put this together with us, and many of their representatives will be speaking over the course of the week. I'd also like to extend a special shout out to the American Retirement Association, whose president, Brian Graff, will be joining us on Friday afternoon to talk about regulatory affairs direct from Washington, D.C. My name is Tom Gaillard. I'm Definiti's Chief Executive Officer, and I always love this time of year. It's a fun time to get together once the deadline of October 15th is passed, the forms are filed, and we can get with our plan sponsors and our plan advisors and provide some interesting, informative education to help you get better at your job. And we hope that that's what will happen for you. I hope you've had a chance to review the agenda for this week. We've got some really interesting topics. Some of the ones I'm looking forward to are tomorrow, whole series on 316 services, which is something that if you don't know much about it, it's worth attending. More and more clients are asking for 316 services, as well as 338 and 321 services. So tomorrow's a full day of that. On Wednesday, my colleague and Chief Information Officer, Terry Bennett, will be joining me to talk about cybersecurity, always a hot topic. And on Friday, as I mentioned, Brian Graff is doing a session on regulatory update. We did get a chat that says no audio. I hope that Metro or others can confirm that we do have audio. It looks like someone else is saying they do have audio, so that's good. So perhaps it's a local control. Okay, a couple of items just to orient you. Your 401k class pass gives you access to every single session. So whether you're a plan sponsor in that track or whether you're a financial advisor in that track, you can jump to whatever sessions are of interest to you. So please do look at everything that's offered each day and choose what you want to attend. All of the sessions will be recorded and then posted. So you can go back and see any sessions that you miss. I think those will be available for quite some time after this week is over. Many of the speakers will take questions at the end of their sessions. At the bottom of your screen, if you hover your mouse down, you'll see a Q&A. And so you can use that Q&A to ask questions. And generally, those will be addressed at the end of the session, although sometimes they might be answered when they're received. And then there's also a chat feature, which people are using now to provide some instruction. Plan sponsors. If there are things that you want to learn more about, more than what you hear today, reach out to your retirement plan consultant. And advisors, same thing, reach out to your sales representative or contact us through the website. We're happy to go deeper. Now with that, we're ready to begin. It's my sincere pleasure to introduce my colleague, Julie Goodwin. Julie hails from Wisconsin, the great state of Wisconsin. She's a senior retirement plan consultant with Definiti. She, after studying marine biology in college, decided to switch over to computer technology and got her major in computer sciences. And after 5 years of working in a software company, decided that retirement services was the place for her. So since that time, and I'm not going to tell you how many years, because that'll date her, she's had quite a bit of experience. She's a great presenter, a wonderful person, and she has a lot to tell you about 401 basics, roles and responsibilities. So I'm going to turn it over to you, Julie, and looking forward to hearing your presentation.
Thanks, Tom. So I am going to start off here and get my items set and ready, and make sure that I am properly sharing my screen. So hopefully everybody can see my screen, roles and responsibilities, whose job is it anyway? And when Elke contacted me about doing a presentation and asked if I would participate, my first question is, what was I going to speak on? Retirement plans can be complicated, and you really need a good team to support you, and that's going to be kind of the motto as we go through all of this, is that everything that we do relies on the team. No one person doing it alone is going to have all the answers, but it's important to know who to go to for the right information. And so as we go through this, you can take some notes. There'll be time at the end for questions. You'll see that as the presentation goes on, it'll kind of list out the roles and the responsibilities of each part of the team. And I'll read through some of it, but some of it will just kind of go over and come back to. Once we get to the end, if as I said, if you have questions, we can go back and kind of review from there. So we'll go ahead and get started. And so the first thing that I want to talk about are the people that are on your team. And from that aspect, we're going to talk about first you as the plan sponsor, us as the TPA, the financial advisor, and your record keeper. And this is your team when you're working on your plan and when it comes to the time to be setting your plan up. Initially, your financial advisor may have come to you about a plan. You may have gone to them. You may have heard something on TV. Maybe you got something in the mail. But when it comes down to it, is that you're going to want to collaborate at least with another individual, another group of individuals, when it comes to consulting and setting up your plan design. If you don't have a good starting point, the plan can be a thorn in your side, and that's why we're all here. Good plan design is critical. Retirement plans are not a one-size-fits-all commodity. Each must be tailored to fit the entity being served. A good case in point would be a plan that's designed for us at Definiti is not going to work for a corporation like McDonald's. It's not going to work for a construction company. And that's because the plan sponsor has a different idea of what they want to provide for their employees and for themselves. And that's why it's important that you just kind of don't take what's given to you off the shelf. And I say off the shelf, I believe at one point I was in a Costco or a Sam's Club when we lived in Alaska, and they actually had a 401k plan you could buy off the shelf. And to me, that was kind of shocking. When you're setting up your plan design initially, you're going to work with all of the individuals listed here. As a plan sponsor, you are ultimately in control of the plan as to what gets accepted and what doesn't. Us as the TPA, we're going to prepare the plan document and provide that to you. We're also going to prepare the plan summary description. You are going to be the one that executes the plan document. Neither our office or your financial advisor is really the one that executes anything. The power is all with you as the plan sponsor. We don't have the authority to adopt a document on your behalf. There are some things, depending on what kind of services you may pick up later, as Tom mentioned, 316, where we become a larger player in your plan. But initially, and for the most part, you as a plan sponsor are going to handle the decision-making process. You're going to base it on the guidance provided by us as a TPA and as your financial advisor. Your financial advisor is going to help you select the investments for your plan, and they're also going to conduct your enrollment meetings. If you're not working with a plan financial advisor, we would advise that you find somebody that you trust. It doesn't have to be somebody that meets with you every 6 months. It doesn't have to be somebody that calls you every week, but somebody that will help you set your plan up and make sure that you have it set with the proper investments and the enrollment meetings for your participants. They will have questions, as will you. Once your plan has been set up, you're going to move into the plan administration process. And this is an ongoing process. It's, your day-to-day. You as the plan sponsor, you're going to remit the payroll contributions. Your record keeper and your TPA do not have access to your payroll information. You are going to have to do that. If you don't want to, there are options. Some payroll companies can automatically submit information to, say, a John Hancock or a principal or things like that. Maybe you have a outsourced, HR company that you're using that they're submitting stuff, but that is ultimately a decision on your side, and that's something that you're responsible for. You will also determine the eligibility for your employees and notify them when they've become eligible. Again, us as a TPA or as your record keeper is not necessarily going to have all that information. You are the holder of the data at its most relevant point. And what that means is that unless you have shared all that information on a timely basis with everybody else on the team, they can't serve you the way you need to be served. During the administration process at the end of the year, your TPA is going to ask for year-end census data and employee questionnaire responses. This information is key in getting you the right compliance testing, helping you prepare your 5500, providing the information to your participants as far as their vesting. Without that information, all of those pieces and that required compliance testing can't occur. As the TPA, we're going to help make sure that the key employees are properly identified and that the HCEs, your highly compensated employees, are also properly identified. We'll base those determinations based on the data that you have provided to us. We're going to review participant allocations compared to what your payroll system has said should have happened and what your record keeper actually received and did happen. Mistakes do happen. I have never worked with a perfect plan. I don't think that they exist. We're all human. Errors do occur. The most important thing is to do what you can to prevent them and address them as soon as possible. We're also going to process your annual employer contributions and perform all of the required non-discrimination testing. All contributions to the plan have to be tested, whether they are deferrals, safe harbor, if they are an employer match, and employer profit sharing. This happens every year. Even if you use a plan that gets a free pass, such as a safe harbor, it still has to be reviewed and the information still has to be provided to make sure that all of the contributions are being made in accordance with the plan document. We're also going to look at what makes a plan top heavy and help you determine that status. We're going to calculate vesting so that you know how much of the employer money belongs to the employee and how much of it is forfeited should they leave before the schedule has been met. Additionally, we also determine your audit status and provide aid to an auditor as necessary. It's important to note that your TPA is typically not the auditor. If your plan is large enough that requires an audit, this has to be done by an outside CPA firm. Your record keeper is also going to allocate contributions to the participants' accounts. They're going to track and monitor your plan and participant allocations, such as a change to a request for 5% instead of 3%, or maybe they want to change their investments. That's all going to happen on the record keeper's side. For the majority of this presentation and for discussion purposes, when we're talking about a record keeper, we're talking about a vendor such as a John Hancock or an American Funds. Plans can and do use brokerage accounts, but those are a little bit of a different type of animal when it comes to some additional work that's required when it comes to the administration of your plan. So that's just something to keep in mind. Your record keeper is also your day-to-day support for your plan participants. Participants have questions about their accounts, especially in the last year, year and a half. Where is my money? What's happening to it? And so you want to make sure that that information for the record keeper is always provided to your participants so that they can be comfortable and confident with what they have for retirement. The record keeper also will have ongoing enrollment and education support. Some vendors are very good and their websites are built to help the participants determine if they're doing everything that they can to set them best up for retirement. such as, tools based on their compensation and their age and what they want to do at retirement. So those are things that would be handled then by the record keeper. You'll notice that throughout there are some areas where we have asterisks and such on what these responsibilities are, and those are shared responsibilities. Depending on what kind of services you select with a record keeper, they may be able to calculate the vesting versus our organization. And again, that is going to be reliant on the data. If we get the data at the end of the year only one time, we are only able to update our vesting one time a year. If, on the other hand, you're providing data to a record keeper every week or every other week, once a month, with every payroll, they're going to be able to calculate vesting and give that information to a participant in a more real-time basis. Typically, the financial advisor is not involved in the administration of the plan on a day-to-day basis, but that doesn't mean that they can't be. Some financial advisors like to be more hands-on and involved when it comes to processing and administration and fielding participant questions. And that is a choice that every financial advisor makes, as well as you as a plan sponsor. Maybe you need more of that support, maybe you don't want that kind of support. Plan conversions. Plan conversions are something that happen for a variety of reasons. And you might be thinking, well, I just started this plan, I don't even need to worry about a plan conversion. But at some point, the chances of your plan going through a conversion of some sort are probably pretty high, and they happen for a variety of reasons. Maybe you change financial advisors. Maybe you didn't have a financial advisor and now you're going to add one, and that financial advisor, has some other suggestions. Maybe you have seen something on TV that says that there are better investment options or services if you move your money here, or maybe you want to go with an alternative. Maybe you're using brokerage accounts and you don't want to do that anymore. It's become too cost prohibitive. Maybe you're at a record keeper and your plan is much smaller, and maybe you want to move to a brokerage account. You might also make a choice to change your TPA, or you may have changes in your company ownership. And I think lately this has been a big change, or more frequent, and that is companies are selling or buying, company owners are retiring or getting out of the business, and you just may need to change and convert your plan. So when your plan goes through a conversion, it's really important that you as a plan sponsor have historical data, both from where you're coming from and being able to provide it to where you're going to. So for example, say you were currently not working with a TPA and now you're choosing to work with a TPA. We're going to need historical data in the form of census information in order for us to make sure that what we're getting is accurate. If your money is coming from a brokerage account into a record keeper, we're going to need to know how much money belongs to each person so that we can coordinate all of the transfers of the assets. You're also going to want to make sure that when you're coordinating everything, that everyone has been notified, and ensure that your plan is in compliance with the ERISA code and the IRS. And what that means is that anytime a participant is going to be unable to access their account for a period of time, they have to be provided with notices. And so that is one of the big things, that timing plays an important role in both the administration and the notification. Another item, or a final item at least to point out, would be that anytime there's a potential for changes in company ownership, you always want to make sure that you have addressed any potential issues with the retirement plan prior to signing on the dotted line. If you're purchasing a company, you want to consider, do they have a retirement plan? How are you purchasing them? That's where your TPA, your financial advisor, can come in, and help and make sure that you don't inadvertently take on a troublesome plan, or that the participants don't know what's going on with their money. Reporting and disclosures. This time of year is a huge time for reporting and disclosures. As Tom mentioned, we just finished up the October 15th filing deadline for the majority of our plans. And that's a really busy time just in general for getting the filing out. The filing is usually due a little bit earlier, July 31st. But once that's done, there are a lot of items that need to go out to your plan participants. Participants need to know about the fees that they may be charged through their plan accounts. They need to make sure that they're notified of their vesting information. You as the plan sponsor are required to provide a summary annual report to all of your participants. The summary annual report summarizes the 5,500. As the TPA, we help prepare that and provide it to you based on the information that you have provided to us. So again, it goes back to you as a plan sponsor providing data going forward so that the other items can be prepared as required. One item that is important to note, and you'll see that the record keeper list over here is a little bit longer, and online access and enrollment are critical at the record keeper. And in general, plan sponsors generally don't load all of their employees to the record keeper. So say you have 10 employees, but only 5 of them participate. Maybe you're only sending information for 5 people to that record keeper. What you're missing out on are some of the services that are provided by your record keeper that now become requirements that you have to cover. For example, fee disclosure. A fee disclosure has to go to every participant, and the IRS eyes participants as any active employee who is eligible to participate regardless of any election to do so, plus any terminated participant with an account balance. So what does that mean? What that means is that if you have 10 employees and 8 of them are eligible, but only 5 of them are participating and your record keeper only knows about 5, you are responsible for making sure that the other 3 are getting the same information. If your record keeper has all of those individuals, you've submitted all their information, even if they're not participating, then the record keeper can provide their notices directly to the plan participants. And I'm just double checking here. This count for your participant notices is also really important when it comes to your audit status. And so, as I mentioned, who the IRS considers a participant. When it comes to an audit count, in an audit generally is plans that have over 120 participants. Those same people, whether participating or not, as long as they are eligible and still employed, would be counted. And so that means if you have 150 people and only 30 of them are participating, but 120 of them are eligible, your plan still would require an audit. And that is why it's really important that you keep the data updated both at the record keeper and at the TPA. So that comes back into play, as I said in the beginning, when at the end of the year we're requesting census information and that you as the plan sponsor are the keeper of the data and you have it at its most relevant point. We don't know, and your record keeper doesn't know what we don't know. So you as a plan sponsor are still in control of all of that information. Ongoing consulting. Change is inevitable, and I think 2020 and 2021 have shown this without fail, probably more times than any of us would ever care to. So each year there is ongoing consulting. You have questions, something's not working, what happened last year? When you're going through the consulting process, are you having testing issues? Did you fail the ADP test? Do you have a low participation rate? Would you like to make larger contributions to your plan? Anytime there are changes that are likely to be implemented, the plan should be reviewed to avoid unintended consequences. What works for somebody down the road may not work for your organization. And I know one of the key things that is talked about right now is after-tax contributions. Can we add more money to the plan or let our employees add more money to the plan? And the short answer is yes. The longer answer is it depends. How will that affect your plan? You want to make sure that before any changes are implemented, that it's reviewed to avoid any unintended consequences. When there's a change that is required, your TPA is going to consult with your financial advisor and with you to discuss what you're trying to accomplish. Is what you're looking for something that can be accomplished within the plan? Do you need a second plan of a different type? Do you need to change eligibility? So those are conversations that we all have together. Once the decision has been made on a change one way or the other, the plan document has to be updated. As a TPA, we would prepare your amendment. As a plan sponsor, you would be responsible for executing that plan amendment. Again, we don't sign. Your financial advisor doesn't sign. Your record keeper doesn't sign. All of that comes to you to sign. And when you get those types of amendments and changes, it can be confusing. I know that a lot of plan documents and restatements and such have gone out at this time, and the email and the information, when you look at it, it can be overwhelming. So that is one of the reasons that, you know, you would employ a TPA, you would employ your financial advisor. They're going to work with you to help you make sure you understand exactly what you're doing, what best suits you, and where to go from there. Excuse me. The TPA is also going to help you address any concerns that I mentioned before about mergers and acquisitions. You know, do you want to take on that plan? Do you want to keep separate plans? Where do you go from here? It can be confusing, and again, it can be overwhelming. And that's one of the most important things, is that you ask questions. Distributions and loans. And I think this has also been something that has come up quite a bit more in the last year and a half. The IRS had frequently changed restrictions and requirements, and was very lenient into what was going to be available for loans and distributions, and what plan sponsors could choose to do and what plan sponsors have to do. Again, we'll go back to the main point. You as the plan sponsor are the keeper of the data, and that means when it comes to distributions and loans, in the best interest of the plan and your participants, the medium for participant requests should really come from you. If a participant needs a form, they should come to you for direction as to where it's available from. Is it a paper form that you have on hand? Is it something that they should get from the record keeper? Is it something they should be directed to do online? And the reason that this comes up, that the participants should come through you, is that you know them. You know if Sally is truly terminated. You know if Bob needed the hardship distribution that came through. You don't know, I should say, we don't always know and aren't able to verify that the person that we're speaking to or the email that we're receiving is coming from the actual participant. Yes, we have access to their accounts online. They can give us their date of birth. They can give us their social security number. But security and identity theft are rampant. And I know that that will be talked about later this week. And you knowing your workforce better than anybody else is best controlled to have you provide the information as to where they can get their distributions, or directing them to the record keeper online, where the online record keeper can send them a text message and ask for the verification code. As annoying or cumbersome as it seems, it's in the best interest of everybody to make sure that that is as locked down as possible. You also want to eliminate the telephone game, and I know I've talked to a lot of participants when I'm working, where they'll get my direct phone number, and one of the biggest things that when I'm talking with somebody is, I hate to tell them I don't know and hang up on them, and in fact I won't, and I'll probably spend more time doing something that I didn't need to, or was a better way, you know, to get them to a record keeper, to try to find somebody to help them. You want to eliminate the telephone game. So if, when you're setting up your plan, you set up a good policy or procedures as to how this would function or where information is going to be found, that will eliminate the telephone game. It gets information faster and in a more consistent manner to your participants, and it gets them what they're needing sooner rather than later. We're still going to be involved on a regular basis when it comes to calculating vesting benefits, getting items reviewed, and making sure the requests meet the requirements of your plan document. But in the end, as a plan sponsor, you also have to authorize all your plan loans and distributions. We review them, but you approve them. The same for the record keeper. If a participant sends a form directly to a record keeper, the record keeper can't approve that without you having approved that. So again, the data is key, and the authorization lies with the plan sponsor. The last set of information that I have on here is just some important plan year-end dates. The dates in red are shown to be based on calendar year dates. As I mentioned earlier, on the right-hand side, right now we're in the process, you'll see the December 1 deadlines for fee disclosure. If there are investment changes that are being made, safe harbor notices, auto-enrollment notices, things like that. It's this time of year. That is something that falls under the reporting and disclosure requirements, and those are items that you're required to give to your plan participants. If you haven't already received some things from our office, you should be expecting them probably in the next couple weeks, especially if your plan is a safe harbor or has auto-enrollment. Fee disclosure items typically come from your vendors, and that information, as I mentioned, can be distributed directly to participants if the vendor knows about them. So that is another reason why you want to make sure that your data is being loaded to your vendors, even if a participant is not choosing to participate. So with that, I'm going to go to the last slide, and I'm going to try to look and see if there are any questions. From what I see is that there aren't really a lot of questions. I am going to jump over and share a separate screen here. And this is the Definiti webpage. And on here, there's a lot of information, and I would encourage you to look at it. But one of the big things that I think would be helpful to any plan sponsor is for you to go out underneath the resources and look for this recent post. And it is entitled Retirement Plan Terms to Know. And just double checking and making sure that you're able to see what I have. Retirement plan terms to know. There's so many things that get tossed around. ADP test, top heavy, key employee, HCE. This information is in here. I kind of wish this had been something that I had known about years and years ago when I first started. It is a good resource to you. There's a lot of things on here that I think you would find helpful. And to that end, I'm going to conclude my presentation. I hope that you find that your plan, while it may seem to be overwhelming at times, is something that doesn't have to be, and that as a team, we're all here to support you and to help your plan be what you want it to be for you and your participants. Next up is going to be Kim Patty, and she will be speaking on eligibility and entry dates. And so with that, I will turn it over to Kim.
Thank you, Julie. Hi, everyone, and thank you for joining me today. I'm Kim Patty, and I am from Northeast Ohio, where we're enjoying an incredibly beautiful day for November 8th. And I am going to be doing the presentation on eligibility and entry. Just waiting for my slides to come up. And in the meantime, I will let you know that I am a manager here at Definiti, working in the defined contribution area. I went to Bucknell University, where I studied mathematics, and have about 25 years working in the industry on retirement plans. So I've worked on both the defined benefit side of things and the defined contribution side of things. The past almost 20 years, I've been working at Brewster & Brewster, which is now Definiti. Okay, so I believe you can now see my screen. And since Julie was just discussing the roles and responsibilities, you all know that there are many people who are part of the defined contribution plan administration. So I thought it made sense to start out with the eligibility, who is involved, and what roles does everybody play. And as you can see from the screen, there are a lot of people involved in the eligibility process. So we'll start with participants. It's the first step in getting employees to save for themselves for retirement. And employees don't do it alone. In general, they're going to be meeting with the people in step 2 there, the investment advisor. And they'll have some interaction with them to do things like determine the plans, to discuss their investment options, help them maybe complete enrollment forms, maybe help them with the online process at the vendor. But anyways, they would work together to get their enrollment set up. And as I mentioned, you can see the third person there, the investment provider. They're the platform used to deposit the money. And they need to be involved in the enrollment process as well, because they have to have the account set up for the participant so that when the participant is enrolled and the money starts coming to the investment provider, they have the right place to put it. And they will be the ones setting up the participant's account. The payroll company is vitally important to the process too, since they're the ones who are going to be actually doing the withholding. And not only do they need to know what percentage of compensation the employee is electing to put into the plan each payroll, they're also going to need to know if they're going to do it as a pre-tax contribution, or if the plan allows for it, a Roth contribution. So it's very important that they know those two things, both the percentage and what type of contribution is going to be deducted. And as Julie mentioned, Definiti is going to be doing basically a double check of the eligibility at the end of the year. But it's really the plan sponsor who determines who is eligible and notifies employees when they become eligible. So that's why we're going to talk about how eligibility works. There we go. How is eligibility determined? So it's the plan document that governs eligibility. And as Julie mentioned, a lot of plan documents have been restated recently. So I highly suggest to every plan sponsor that you go and review the provisions in your current signed document. Make sure that you are in agreement as to what the document says and what your practice is. And it doesn't matter what's in the employee handbook or in other types of communications. And it doesn't matter what you told somebody when they were hired. I've had this come up in many instances throughout the years. I'll have a plan sponsor tell me that they interviewed Bob, and Bob wants to work for him, but he wants to start deferring right away because he's able to defer at his previous company, and he doesn't want to have any time where he's not actually making deferrals to the plan. And you really want Bob to start working for you, so you say, okay, Bob, you can start right away. Well, that's not the way that eligibility works, and you can't just tell one person that they're able to come in right away when everybody else needs to wait. So please make sure that you're following the terms of the plans with every person that you're hiring. And again, it's the plan document that governs the rules. Eligibility and entry dates are important to get right. So it is a compliance issue. If your plan is going to be audited, they are going to look, the IRS is going to come in and look to make sure that the people who are eligible actually became enrolled in the plan. You're going to need to keep things like the enrollment materials to make sure that you have a form on file, either electronically or a paper form that shows every participant who is eligible to be enrolled is actually enrolled, even if the participant elected not to participate in the plan. So if they wanted to defer 0% of their compensation, you need to make sure that there is something on file that indicates that. And please reach out to your plan consultant to make sure you understand the rules of eligibility. So now let's talk about how to determine eligibility. Step one is you're going to identify your employees. Anyone working for the employer is an employee. Independent contractors who only get 1099 are not considered employees. But basically, if a person receives a W-2 from the company, they would be considered an employee. Definiti performs compliance testing on a yearly basis. And the only way the testing can be accurate is if we receive information on all employees on a yearly basis. So when you're providing that census information to us at the end of the year, please make sure you're including everyone who has a W-2. If we're not given all of the information, we may not be able to provide accurate compliance results. So that is step one, determining who is an employee. Step two is identifying the eligible employees. Plan documents are allowed to exclude all sorts of different groups of employees. So some common exclusions are union employees, non-resident aliens, and leased employees. And if your plan excludes one or all of those groups, you're basically given a free pass from the government, and they consider that fine. You don't have to test that and make sure that your plan passes any certain kind of testing. However, the plan could exclude groups of people that don't get a free pass. You could exclude hourly employees. You could exclude commissioned employees. You could exclude people who work in a certain location, maybe a certain division, or people who have a certain job title. There's all sorts of ways you could exclude groups of people. And while you're allowed to do that, you must also test it on a yearly basis to make sure that you're covering enough people in the plan. And it is something that needs to be looked at year by year. So for instance, if you start a new division in a certain location and you only have a few people working there, in the beginning, it may be fine to exclude that group of people from the plan. But as that division grows and more people go to that location, it is possible that you could run into trouble later off down the road. So you do need to keep an eye on that and make sure that you are including enough people in the plan. And that's something that Definiti can help you with on a yearly basis. So step three is identifying the plan's eligibility requirements. And plans can be set up with many different types of requirements. You look at a plan document, you may see 3 or 4 pages just describing who is eligible for the plan. But typically, you're going to have an age component and a service component. And the statutory maximum age that you're allowed to keep somebody out of a 401k plan is age 21. So you're not going to see an age 25 requirement in the 401k plan. You could have no age requirement whatsoever, or an age requirement like age 18. And the statutory maximum amount of time that someone is allowed to be out of a 401k plan is 1 year of service. So 1 year is considered to be a 12-month period of time that 1,000 hours are worked. And as you can tell, this is slightly less than 20 hours a week in order to be eligible. And I wanted to make a note of that because this is a common misconception that some plan sponsors have. They say, well, that person's part-time, they're never going to come into the plan. But even if they only work a little bit less than half-time, it's possible that they're going to get their 1,000 hours, and it's likely they're going to enter the plan. So please keep that in mind. Another common requirement is using elapsed time to determine eligibility. And elapsed time is really just simply how much time has passed since the employee was hired. So in the bullet point there, you'll see an eligibility requirement of 18 years of age and 3 months elapsed time. So you would just look ahead 3 months to see if they have met the eligibility requirements. And we're going to use these two in some upcoming examples. So we have age 21 and 1 year of service as one of the types of eligibility requirements, and age 18 with 3 months. So let's look at an example. Sorry about that. Suppose Jennifer is a new employee who was hired in February 2021. She's 35 years old and will work full-time. The plan document says that employees are eligible when they are age 21 with 1 year of service, which is a 12-month period with 1,000 hours. When is the earliest Jennifer could be eligible? Well, if her date of hire is 2/15/2021, we look forward to her anniversary year, the date that it's her 1 year anniversary, and that's 2/15/2022. And we see how many hours of service she had during that period, or the computation period. In this case, we're saying that Jennifer is full-time, so maybe she works around 20-80 hours. Therefore, she meets eligibility on 2/15/2022, which is her anniversary date. Note that she does not meet the eligibility right when she hits her 1,000 hours. So if she hits her 1,000 hours in August, that's not the date she becomes eligible. We're looking at a 12-month period of time. So now let's look at another example, which has the same facts as before, but assume Jennifer only works 950 hours in the first year. And when is the earliest Jennifer could be eligible in that case? So again, she's hired in February of 2021. We look to her 1 year anniversary date to figure out our computation period, but she only worked 950 hours during that time. In general, most plans are written that after you get past your first anniversary date, you switch the time that you look for eligibility to each plan year. So assuming this is a calendar year plan year, we're going to have a new computation period, and we're going to look at her hours from 1/1/2022 to 12/31/2022. She would meet eligibility on 1/1/2023 if she works over 1,000 hours during that time. And it's going to continue on that way in the future. So if she only worked 800 hours in 2022, you look at her total hours for the plan year in 2023 to see if she'd be eligible in 2024. Now let's look at an elapsed time example. So it's the same facts as before, but instead of age 21 and 1, we're going to say eligibility requirements in the plan document are age 18 with 3 months of service elapsed time. When is the earliest Jennifer could be eligible? Well, if she was hired 2/15/2021, all we need to do is look for her 3-month anniversary, which would be 5/15/2021. If she's still employed on that date, then that is the date she meets eligibility. Doesn't matter how many hours she worked in those first 3 months. It just matters that she is employed on 5/15/2021. So once we have someone who has met the plan's eligibility requirements, the next step is to determine what date they enter the plan. This is the date that the payroll deductions start and the employee begins participating in the plan. In general, participants enter the plan on the entry date that either coincides with or follows the date that they meet eligibility. Now, the maximum allowable time that someone's allowed to wait to enter after meeting eligibility is 6 months. So that's why we commonly see dual entry dates in a calendar year plan of January 1st and July 1st as one of the most common entry dates. Having 2 dates a year also simplifies the enrollment process, since you would only have 2 dates to organize the whole enrollment system. But other common entry dates are things like quarterly. You could have monthly dates. You could have the entry date be the first of the next payroll period, or even have immediate entry where you could be entering someone into a plan 365 days a year. It really just depends on what everybody wants. Some people think that waiting the 6 months after meeting eligibility could be a long period of time to make someone wait. It could be up to like 18 months, in which case you may want to put in an entry date more frequently. And now let's look at an entry example. The same facts as before, but we're going to look at when the person actually enters the plan. We're going to assume that entry is semi-annual. So if Jennifer, on her first anniversary date, met the hours requirement and met the age requirement, that means she met eligibility on 2/15/2022. There's only 2 entry dates a year because it's semi-annual entry. We've already passed January 1st, so the next entry date would be July 1st, 2022, and that's when she would enter the plan. Now, same facts, but entry is monthly. When would Jennifer enter the plan? Well, if she meets eligibility on 2/15/2022, the first of the next month is March 1st, 2022, and that's when she would enter the plan. Now, I will say if she was hired on 2/1/2021, meaning her first anniversary was 2/1/2022, she would likely enter the plan on 2/1/2022, her anniversary date, since it coincides with an entry date for the plan for the year. So now we've got the basics of eligibility and entry, and let's move on to another topic. So rehires are very important to cover when it comes to eligibility and enrollment. Plan sponsors need to keep very detailed records for all employees so that we have everybody's employment dates, including their past history. In general, if a person was ever eligible to defer in the past, they immediately come back into the plan on their date of rehire, and can start participating in the plan on their first day back. So if the employee met eligibility during their past employment, but they terminated before they got to that entry date, but then they're later rehired after the entry date has already passed, these people are eligible upon rehire also. So I know that can be a little bit confusing. But also, if the employee did not meet eligibility, terminated, and later rehired after their first anniversary year, then the consultation period is going to move to the plan year. You have to look each plan year to determine if they meet the service and hours requirement. Like I said, I know that can be kind of confusing. So let's look at some examples to demonstrate how rehires work. Okay, so similar to the eligibility and entry dates, Jennifer meets eligibility on 2/15/2022 because she's old enough and she worked enough hours, and she would be eligible to enter the plan on July 1st, 2022. However, she terminates on June 15th, 2022, and is rehired on September 15th, 2022, after that July 1st date has passed. So when does she start participating in the plan? Well, her entry date is her rehire date of September 15th, 2022, since the original entry date has already passed. And as a matter of fact, I had a phone call with a plan sponsor this morning who had this exact same situation with one of her plans. It was an elapsed time participant, and they had met the 6-month requirement, and almost immediately after they terminated, and then they came back again and they were eligible on their first day back. So it works for elapsed time as well. So now let's look at the case where the participant didn't meet the hours requirement in the first 12 months and terminates employment and then is later rehired. So if she only worked 950 hours during that first computation period, the computation period switches to the plan year just like it did when she didn't have a termination and rehire. And you need to look at how many hours she works every plan year. The first plan year being 1/1/2022 to 12/31/22. If she does happen to work over 1,000 hours during that period of time, even if she does have a break in service and is terminated and rehired, she would still enter the plan on 1/1/2023. And I've said it before, but rehires can be very confusing. So please reach out to your consultant with any questions on them. And there's also another option to enrolling participants, and that's automatic enrollment. So instead of kind of leaving it up to the participant to make an election and complete all the forms, the plan could be set up to automatically enroll newly eligible participants. And the percentage that you enroll the participant at is set in the plan document. If the participant does nothing at all, then they are enrolled in the plan, and they, as soon as their entry date hits, the withholding has to start and the money gets deposited into their account. Now they can, however, opt out, just as you can kind of opt in for a non-automatic enrollment plan. So that's the way that works. And, you know, like I said, the percentage that they're enrolled at is specified in the document. And not only that, but you can also set it up so that you not only automatically enroll them at that percentage, but every year thereafter you could increase. And so oftentimes you'll see we're going to automatically enroll our participants at 3%, but then after a year we're going to increase it up to 4%, and then 5%, 6%, 7%, up to a certain maximum percentage. So you can really get participants to start saving for their retirement and have much more in there than they might otherwise have if they were doing it on their own. So that's one of the pros for having automatic enrollment. And Julie had mentioned ADP testing, and that is a kind of test where you compare the rank and file and the percentage that they put in to what the owners of the company or the highly paid people put into the plan. And some companies have trouble passing this test. Well, if you do automatic enrollment, you may be able to increase the percentages to the rank and file, which may make it easier to pass your ADP testing. And also, the more people who are enrolled in the plan, the more who are saving for their own retirement. Now, some downsides include, well, if you're having more people defer into the plan and the deferrals are higher than what they normally would be, if you are making a matching contribution, the match could be more expensive. And also, if you're doing the increases, so not only automatically enrolling them, but then increasing it year by year by year, that could be a little bit more administratively challenging than having the regular 401k enrollment. And also another thing to consider is that corrections would be required if contributions aren't started in time. But I will say corrections are required for all types of plans, not just automatic enrollment plans. And I know Julie brought up corrections earlier, and she said she's never had a perfect plan. I mean, corrections happen all of the time. Almost everything is fixable, and it's not a big deal. This happens all the time. What if I bring a person in early? You know, maybe you had the wrong age, or maybe you had a typo in their date of hire, and you accidentally brought them into the plan too early. You usually have two types of corrections that you could do. You could have amend the plan so that the plan now says what you actually did as far as operations go. So you let this person in early, so now you amend your plan to say, oh, it's okay to let that person in early. Or you may have to just correct the money in the account and fix it outside of the plan. A lot of plan sponsors like the first option of amending the plan, but I will say that you can't do that in every situation. So say the owner accidentally brought his son into the plan too early, and that was the only person that was brought in too early, you're not going to be able to correct that through a plan amendment. But what happens if you bring in a person too late? So if someone is brought in late, in general, the company needs to make up for the money that the employee missed the chance to put in themselves. And not only that, if there was a matching contribution, the employer would also have to make up for that portion if the plan has a matching contribution for the period of time that the person wasn't able or could not do the deferrals. So you have not only the amount that they missed in deferring out of their own paychecks, but they also missed the match that would have gone with it. And in general, the employer would need to make up for that. Now that can be kind of expensive, so you want to make sure that you're comfortable with the enrollment process. And I also want to say, the sooner you catch it, the less expensive it will be. So if you happen to notice something, you'll want to bring it to your consultant's attention right away so they can help you correct and get it fixed. The sooner the better. And if you have any questions on a specific individual, please give us a call. Also involved with enrollment are notices, and Julie kind of touched base on this too, because she was saying about all the things that were due in December. Well, these are all going to be due anytime you enroll somebody in the plan. The first is your summary plan description. That is an easier to read version of your plan's adoption agreement, and it's going to have all of the provisions in the plan, and that way the participant knows how the plan works. You're also going to have a summary of material modifications, and that would happen if your plan was amended since you did the last summary plan description. So it's just usually a short summary of what the change in the plan was. And that would go along with the summary plan description, so the participant has a complete idea of how the plan actually is working. You would also have to distribute them an annual notice, which could be something like the safe harbor notice, the automatic enrollment notice. It could be a QDIA notice or fee disclosure, anything that needs to be done yearly. If you haven't done so already, you need to give the participant that when you enroll them. The participant would also have to elect a beneficiary, and that could be done online or through the form, but the plan sponsor needs to make sure that they are aware of who the beneficiary is, so that in the case something happens, they know who to go to for the money in the plan. Kind of obviously, the participant has to make a deferral election form to elect not only the percentage like we talked about, but also whether it's going to be pre-tax 401k contribution or an after-tax Roth contribution. And any forms that are needed to set up their account. So forms where they're picking their investment elections or any other account establishment forms. So those are the notices that need to be given when somebody becomes eligible for the plan. Now let me take a look to see what questions we may have. I have a minute here left. So one question we have is, can you have different eligibility requirements for different types of contributions? And yes, you can. So I was going through the presentation as though a participant gets enrolled in all of the different sources of money in the plan at the same time. But you could have one type of eligibility requirement for your 401k and Roth deferrals, and then something separate for match and or profit sharing. And sometimes you see this because participants may want to, or plan sponsors may want to allow participants to start deferring right away because they were deferring at their prior company, but they may want to wait a while before they give them any type of employer contributions. So sometimes you do see different eligibility requirements between their deferrals and what is going in for match and profit sharing. At this point, I want to thank you all for your time. And I am now going to hand it over to Christopher Wilson, who is going to discuss Safe Harbor Plan.
Hello, everyone. Can you see me? I hope. 1 second here. So let's start off. Basics of a Safe Harbor 401k plan. Okay. The purpose of a Safe Harbor 401k plan is to permit highly compensated employees to contribute the maximum salary deferral permitted under law without subjecting the plan to what is called an ADP test. That compares the salary deferral rates of highly compensated employees to non-highly compensated employees. And there is only a permitted disparity that is allowed by law. And if that disparity is too great, meaning that the highly compensated group has deferred more of their income than the non-highly compensated employee group, then the highly compensated employee group typically has to take back a portion of their contributions with earnings, or the employer would be forced to make a contribution for the non-highly compensated employee group. Okay, so putting in an ADP safe harbor provision eliminates the need for that test, and it allows the highly compensated employees to maximize their salary deferrals. All right. So we're going to go over, there's 5 safe harbor plan designs that we're going to discuss. Okay. I've just outlined them here. There's a 3% non-elective, and this is given to all employees whether they make a salary deferral or not. Okay. There's a basic match, and a match, anytime you have a matching contribution, this requires the employee to make a contribution. Okay. Under a basic match scenario, the deferral is matched dollar for dollar up to 3%, and it's 50 cents on the dollar up to the next 2%. So if an employee is deferring 5%, the maximum match they will get is 4%. You can also do an enhanced match where it's dollar for dollar up to 4% of pay, or you could do dollar for dollar up to 6% of pay. Okay, you'll notice under the 4%, you get the same result as you would under the basic match. Okay, the only difference is the gap here between 4 and 5%. All right, there's a QACA match. This is a qualified automatic contribution arrangement. Okay, and here you can put in a basic match, which is less than the basic match over here. Okay, but you also can do an enhanced match, which is the same as right here. All right, and the last is called a 3-tier match. Some of you may have heard this as a stacked match. Okay, and that's where you put in a basic match here or an enhanced match here to satisfy the ADP safe harbor. You put in a discretionary match to satisfy the ACP safe harbor, and then you can put in a fixed match on top of that. And all of these qualify as safe harbor. All right. So let's talk about the 3% non-elective. So you must provide all non-highly compensated employee participants during the plan year the 3% contribution. It doesn't matter whether or not they've made a salary deferral. It doesn't matter whether or not they've satisfied an hours of service requirement, if that's in the plan document, or if they've been employed on the last day. If they are employed on the first day of the plan year and they are a participant in the plan, they will get a 3% contribution. That is 3% of their total compensation. Okay. You may provide this to highly compensated employees. It's not required. Some documents do, some documents don't. The advantage to not giving it to highly compensated employees is if you have a lean year where you are not able to make an employer contribution, or as much of an employer contribution as you would like, you're not going to be forced to give away money to highly compensated employees. Okay, you have to put away for non-highly compensated employees, but you're not going to be forced to put away for the highly compensated employees. All right. Again, it's based on the participant's plan compensation for the plan year. If your plan defines compensation as compensation from the date of entry, the 3% can also be based on that. We call that post-entry compensation. Okay. If the only contributions made to this type of plan is the 3% non-elective and the salary deferrals, okay, then we say this plan is exempt from a top-heavy contribution requirement. And again, it's provided that no other type of contributions are made to the plan. Also, the eligibility for deferrals may not be more liberal than that for the safe harbor contribution, okay? So let me back up for a second, what we mean by top-heavy. A top-heavy plan is a plan in which more than 60% of the assets are for the benefit of key employees. Key employees are owners and officers, okay? If a key employee makes a contribution in the form of a salary deferral or receives a contribution in the form of an employer contribution, and the plan is top-heavy, then a top-heavy contribution must be provided to all non-key employees, okay? But again, in this case, if the 3% non-elective and the salary deferrals are the only contributions made to the plan, we don't have to worry about satisfying a top-heavy contribution requirement. But what's important here is the eligibility for salary deferrals may not be more liberal than the safe harbor contribution. I've given an example here. If the eligibility requirements to make salary deferrals are 6 months and age 21 and entries on the first day of the month, the eligibility to receive the safe harbor contribution is 1 year of service, age 21, and entry is on the first day of the month and the first day of the 7th month of the plan year, and the plan is top heavy. What's going on here is you're bringing in employees into the plan at 6 months, age 21 on the first of the month. You're bringing them earlier than you normally would under age 21 and 1. Once someone becomes a participant in the plan and the plan is top heavy, they must receive a top heavy contribution. Okay. So you want to be careful of this. Okay. Safe harbor contributions are always fully and immediately vested. There is no vesting schedule tied to them. Once they are contributed to the plan for the employee, they are fully vested. So once the employee, once there's a distributable event, the employee is allowed to take 100% of that account balance with the earnings, okay? This type of contribution, the 3% non-elective, and let me tell you what non-elective means. Non-elective means that the employee does not get to elect the contribution. It is put on their behalf by the employer. That's why we call it a non-elective, okay? It's best suited for top-heavy plans with what we call a new comparability allocation method for profit-sharing contributions, which we're not going to get into. But this 3% contribution is included in the overall profit-sharing contribution for this plan. So it makes it ideally suited for this type of plan, okay? So if you have this type of plan, you'll understand why we have this 3% that we're using with your new comparability allocation method. Okay. The next safe harbor match is what we call the basic match. Okay. Your basic match is 100% of salary deferrals up to the first 3% of plan compensation, then 50% of salary deferrals up to the next 2% of plan compensation. And as I said earlier, if a participant is deferring 5%, the maximum matching contribution they will get is 4%. Okay, it's between 3 and 5% that 50% of the next 2% comes in. Okay. This match is provided to all participants with a salary deferral during the year. And again, you can't impose a last day or hours of service requirement. If they made a deferral, they're going to get the match. Okay. Again, it may be based on a participant's plan compensation for the plan year, the payroll period, the plan year quarter, calendar month, or any other period. Okay, that is defined in the plan document. Okay, and this is the value of your third-party administrator. Okay, is they will be able to explain to you what the best plan design is in order to meet your objectives. All right. Now, in some cases, a true-up contribution may be required, and I'll explain why that is. Okay. here we have two employees. We have plan year compensation. We have plan entry date. And this is their compensation from their entry date. So they're entering July 1st. So I simply just took 50% of their full plan year comp, okay? And I gave them two different salary deferral starting dates, July 1st and October 1st, okay? And this is their payroll compensation that they're going to be deferring on, okay? Now, if you notice here, once they start deferring off their payroll compensation, they get a total match of 4%, okay? But if you take this matching contribution here as a percentage of their post-entry compensation, this person is at 4% because, again, their post-entry compensation is the same as their payroll compensation. But this person didn't start until October 1st. So their match is only for the last quarter. So as a percentage of their post-entry compensation, it's only 2%. Now, if you take their matching contribution as a percentage of their full plan year compensation, which is over here, it drops down even further, okay? When we look at their full year deferral rate, we're taking their entire salary deferral divided by their compensation. We've got a deferral rate here of 5%. We've got a deferral rate here of 2.5%, okay? If the plan document defines the compensation to be used for the matching contribution as the plan year compensation, but you as an employer are depositing the matching contribution throughout the year, then you may have to make what we call an additional true-up matching contribution, because the matching contribution is calculated based on plan year compensation or post-entry compensation, not compensation for each payroll period. So under this scenario, this person would need an additional match of $1,240. This person would need an additional match of $2,340. And that gets them the 4% of their plan year compensation, okay? So this is where, again, your TPA comes in. You want to talk to your retirement plan consultant, and you want to be crystal clear as to what definition of compensation is being used to compute the matching contribution. Okay, there's absolutely nothing wrong with making a true-up contribution at the end of the year if that's what you want. But if you don't want a true-up contribution, then you need to make sure that you're calculating the matching contribution based on payroll period compensation. Okay, so if this is something you want to talk to your retirement plan consultant about. Okay, and again, this plan, the top heavy, it's exempt from top heavy minimum contribution requirement because the basic match and the deferral are the only contributions being made to the plan. And again, safe harbor contributions are always fully and immediately vested. The enhanced match is simply the basic match, but we've just simply increased the formula. Instead of doing 100% of deferrals on the first 3% plus 50% on the next 2%, we're simply going to give people 100% up to the first 4%, okay? Or you could also give them 100% up to the first 6% of plan compensation. We just call this an enhanced match, okay? Again, it's provided to all participants with a salary deferral during the plan year. You may not impose a last day or hours of service requirement. Just like the basic match and the 3% safe harbor non-elective, it can be based on a participant's plan compensation or partial compensation. Again, this is defined in the plan document. Just like I just discussed, a true-up contribution may be required if the safe harbor match is deposited on a more frequent basis than the periodic compensation to calculate the match. Again, if the compensation used to calculate the match, as defined in the plan document, is plan year compensation, and you're making the contribution throughout the year, you're going to have to figure out if they need a true-up contribution, okay? And again, this is exempt from top heavy, just like all the others, and it's fully and immediately vested. The QACA match. The QACA match requires what we call automatic enrollment of participants. There's two types of enrollment. A participant may come to you and say, I wish to enroll in the plan at 5% of my salary. That's what I want to contribute to the plan. That's called an affirmative election. An automatic enrollment is called a negative election. Participants are automatically enrolled in the plan at a prescribed deferral rate. They would have to submit an affirmative election to negate that negative election, okay? So an affirmative election also includes a salary deferral rate of 0. So if someone doesn't want to make a salary deferral, they still need to provide you as the plan sponsor a salary deferral reduction agreement, an election form that states 0%, okay? For a QACA, qualified automatic contribution arrangement, the default deferral percentage cannot be less than 3% for the first 2 years of participation. The third year, it goes to 4%. During the fourth year, it goes to 5%, and then it's 6% every year thereafter, okay? This escalation of deferrals isn't required if your default percentage begins at 6%. So if you're going to begin at 3% or 4% or 5%, you need to escalate. If you're going to start at 6%, you do not need this escalation feature. The maximum the default deferral percentage may not exceed 10%. So you can start at 10% if you want to, okay? The big issue with a qualified automatic contribution arrangement is who's going to track the escalation of salary deferrals, okay? This is best left to automation, but if you don't have those kind of tools available to you, someone's gonna have to track this, either your payroll company. If you're doing payroll in-house, you're gonna have to track it. Some TPAs may do this, some may not. You'd want to talk to your retirement plan consultant to determine that that's something we can do for you. I'm not sure if that is part of our 316 fiduciary services. I can certainly check on that and get back to you. That is one thing I did not, that's one thing I was not able to check on before presenting this morning. So I can get back to you on that, okay? As an alternative, the employer may make a 3% non-elective contribution instead of the matching contribution. It's the same 3% non-elective contribution that we discussed earlier, okay? They can also make an enhanced matching contribution that must be at least as much as the basic match at each tier. Again, this goes back to the enhanced matching contribution of 4 or 6%, okay? Salary deferrals may not exceed 6% of plan compensation. Now, unlike the other safe harbor methods, the 3% non-elective, the basic match, and the enhanced match, the QACA match you may subject to a vesting schedule. So you make, it's called the 2-year cliff schedule, meaning it goes from 0% to 100% at 2 years of vesting service, okay? It's the only safe harbor that has a vesting schedule attached to it, okay? The plan sponsor may also permit participants to withdraw their contributions between 30 and 90 days from the dates the salary deferrals were withheld from compensation. So if you automatically withheld salary deferrals from an employee's pay, they can come to you within 30 and 90 days of that withholding and say to you, I want those deferrals back, okay? At which point they would have to, enter into an affirmative deferral election to tell you that they don't want any deferrals withheld, or they could withhold them at a rate less than the default deferral rate that you've put into your plan document, okay? And again, this plan is exempt from top-heavy contribution requirements, all right? Okay, then there's the tiered match. Under the 3-tier match method, there's a first match which we call satisfies the ADP safe harbor, okay? The match may not exceed 6% of plan compensation. Deferrals and exceeded 6% of plan compensation. You could do a basic match. You could do an enhanced match of 4 or 6%. So I've done the calculations for you here. This is based on 2021 limits. The 2022 limits just came out, but they came out after I had completed this presentation. So under each of these scenarios, you would see what the matching contribution would be: 11,600 under both of these, 17,400 under this, okay? The second tier satisfies what we call the ACP safe harbor. You may not match deferrals in excess of 6% of planned compensation, and you cannot exceed 4% of planned compensation. So what this ends up working out to is they get a 66.67% of match on 6% of deferrals, which is capped at $290,000 of planned compensation. This is the maximum compensation we can consider for planned purposes for 2021. That ends up being a match of $11,600. Oops. Okay, then we go down to the third tier, which is a fixed match. Okay, and again, this match may not exceed 6% of planned compensation. How much of this you have to calculate? So 58,000 is the maximum. We call this the annual additions limit. This is the maximum amount of money that a participant may receive in a plan year. Okay, we're going to subtract off the deferrals of 19,500. Okay, that's the 2021 salary deferral limit. Okay, we're going to subtract off the first match of 11,000. Oops, I shouldn't be clicking as I'm pointing. We're going to subtract off 11,600 from the first match up here. And we're going to subtract off 11,600 as the second tier match. And this is the remaining match they're allowed to put away, 15,300. As a percentage of compensation, it's 5.28%. That's simply 15,300 divided by $290,000, okay? But what we really need to do is we need to calculate what this is as a percentage of salary deferrals up to 6% of planned compensation. And this is the calculation right here. We simply take the match divided by our compensation times 6%. It works out to 87.93. Okay. The same under the enhanced match. Under the 6% enhanced match, it's a little bit less, 54.6, because they're getting a greater match up here. So they're going to be getting, oops, sorry. So they're getting less match here. Okay. The reason you need to calculate this fixed max percentage is because this needs to be in the plan document. Okay. Under the fixed matched section of your plan document. This has to be in there. Okay. Now, every year as limits change, as these limits change, the 290,000 and the salary deferral, you need to calculate what the fixed match percentage is going to be for that year. And you need to amend your plan document before the end of the year. So if you have a fixed match in your plan document, please make sure you talk to your retirement plan consultant to make sure that the percentage in your plan document is the percentage you want to be using for 2022. Okay. And again, it has to be amended before the beginning of the next plan year. Okay, let's go through the plan document and notice requirements real quick. All of these have to be specified in the plan document. Okay, for the 3% non-elective, there's actually two different notice methods you can use. You can use a one-time notice method, or you can use what we call supplemental safe harbor notice method, under which the single notice method, one notice is given 30 to 90 days before the beginning of the plan year. Those are for your existing plan participants. For new participants, you have to give it no earlier than 90 days and no later than the date the employee satisfies the eligibility requirements. So as you have employees satisfy the eligibility requirements during the plan year, you need to make sure that they're getting a copy of the safe harbor notice. Okay. If you're using the supplemental notice method, which we call the two notice method, one notice is sent before the beginning of the plan year, just like it is up here. But then a second notice is provided no later than 30 days before the end of the plan year, in which you commit to the safe harbor provision. If you do not provide this notice, then under most circumstances, your plan will not have a safe harbor provision for that plan year. Okay. Under the basic or enhanced match, there's only one notice method. It's a single notice method. It has to be given again 30 to 90 days before the beginning of the plan year. Okay. The basic or enhanced QACA match, again, the notice has to be given 30 to 90 days before the beginning of the plan year. What also has to be stated is the automatic deferral percentage. This is the default deferral percentage. And whether there's going to be an automatic increase, that also has to be in the notice. Also in the notice has to be whether or not you as the plan sponsor are going to permit withdrawals of those default deferrals. Okay, that also has to be in the notice. Okay. Under the three-tiered match, it's the same thing. You have to give a notice 30 to 90 days ahead of the plan year for the ADP safe harbor notice. Okay. The ACP safe harbor notice doesn't necessarily have to be specified as an ACP safe harbor match in your plan document, provided it meets the requirements of an ACP safe harbor match, meaning it can be stated as a discretionary match. It doesn't have to necessarily be stated as an ACP safe harbor match in your plan document. And again, your retirement plan consultant can take you through this. Okay. So that is safe harbor contributions in a nutshell. Okay. Are there any questions that I can take from the audience? Do I not see any hands? Do not see any. I'm not hearing anyone. Can you all hear me? Hello?
Chris, we can hear you just fine.
Oh, Tom. Okay, there you are. Okay, okay. I didn't hear any feedback. I wasn't sure if I was still live or not. So, and here's one question and answer. Oh, I can hear me. Okay, so everyone can read. So do I have any questions from anyone in the audience about the basics of safe harbor provisions?
Chris, this Elke, it does look like we do have one question.
Okay.
Somebody entered in chat.
Oh, okay.
Will Definiti provide plan sponsors with the notice requirement when it's due?
That depends. We can do it. We can most certainly do it, or we can work with your vendor. If your assets are with a vendor such as American Funds or John Hancock or Transamerica, Voya, they also have the ability to provide a safe harbor notice to you. So you'll have to work with your retirement plan consultant to determine which is best, whether we provide it to you or whether the vendor provides it to you. There are plus and minuses to both methods, and that's something your retirement plan consultant can work with you on.
Thank you. It looks like we do have one other question, and I'll note that there are a few of you who've raised your hand. If you do have a question, go ahead and enter your question in the Q&A panel. There we go. So we may have some additional questions here. This is a big topic. One of the questions that came in chat was, can the hourly requirement be removed from a safe harbor plan?
There is no hourly requirement. Are you well, there is no hourly requirement for safe harbor contribution. You cannot, that's not permitted. If you're talking about an hourly requirement attached to a discretionary contribution, you certainly can remove that. You do not have to have an hours of service requirement. That's discretionary.
Great, thank you. And there's a question about what's available after the presentation. So all of these sessions will be recorded, and after those have been edited, then they will be added to the event webpage where you went today to join the session. So you'll be able to see the replays there. If you have further questions about your plan, best course of action is to reach out to your RPC. I'm sorry, it does look like we've got two more questions. What about the, oh, well, this question. So what about the new law about part-time workers only needing to meet 500 hours of eligibility? And before you answer that, let me share that Brooke Cozart, who is our ERISA attorney, will be on later in the week to talk specifically about that question. So she's going to spend a lot of time about part-time, long-time part-time people.
Right, correct. Yeah. That in itself is an entire
Yeah.
presentation. Yeah.
Yeah. So many of the questions are about that. So I would say if you have a question about long-term part-time employees, then I would say be sure to sign up or attend on Brooke's presentation day when she'll be talking about that. And I'm just going to double check and make sure that is in fact going to be, yes, that will be on Friday of this week. So she will talk specifically about that. So all of those questions about part-time, long-term part-time employees, I would say sign up again to the presentation on Friday, and Brooke will answer all of those questions and more. With that, I think that's going to take care of it for right now. So Tom, I'll pass it back to you.
Okay, well, thank you, Chris. A great presentation. And also I want to thank Kim Patty and Julie Goodwin for their presentations earlier today. I hope that was useful to all of you. Really appreciate the interest. We have close to 200 participants on today's call, so they seem to have struck some interest. And as Elke just said, there are a number of interesting stuff coming up. Chris had briefly mentioned 316 services. Tomorrow is 316 day, so there's a lot of programming. Check your schedule, but same time, same place. And then later this week, all sorts of other interesting topics. So thanks again for your interest, and we look forward to seeing all of you tomorrow and through the week. Thank you very much.